Hey everyone, Eric Dutram here with the latest edition of the Dutram Report, the podcast on ETFs and more. Today we're taking a slightly different approach for this edition, as I'm going to do most of the talking this time, focusing in on an area of low-cost ETFs for today's podcast. I have some quotes from Jonathan de St. Pierre, Senior Vice President of Strategy and Product at Charles Schwab, for some insights on this topic too, so make sure to stay tuned for that right after this. Okay, everyone, I wanted to talk a bit about one of the biggest trends in the ETF industry as of late, and that is this push towards ultra-low costs. What is going on here, and why are providers going so crazy over this? Yeah, it is great for us on the receiving end, but still, providers are basically falling all over themselves in terms of trying to provide lower costs across the board, and we see several funds below 7 basis points in terms of cost per year as well. In fact, even if you're at 7 basis points a year, you wouldn't even get into the top 10 for lowest cost funds out there. And really, to me, this is just part of a larger fee war among providers. And that makes a lot of sense because all these funds have basically the same focus. Once you have a large cap product and 4 of your competitors have the same thing, the only way to really compete is on cost. And I think that's why we're seeing costs really drive down among all these large cap, small cap ETFs, and even some of the broad market international and bond funds as well. Now, one of the leaders in this area is really Charles Schwab, a company that completely dominates the low-cost world. And this is kind of a surprise because they're a relative upstart in the space, but about half of the 20 cheapest funds in the market right now come to us from this provider. I talked to Jonathan de St. Pierre of Charles Schwab for some insights in this topic. In particular, I want to know why the focus on low cost seemingly above all else for Charles Schwab lately.
Well, at Schwab, we really think about it that putting our clients first is in our DNA. And in thinking about that, we also know that today's consumers expect great value, a great experience, and even a refund if they aren't satisfied. So our recent announcement really does think about that in terms of the costs, but the announcement's about much more than just costs. Because yes, costs matter, and they're absolutely critical, but we also want to make sure that clients don't need to sacrifice on quality to get lower costs. We also want to make sure that everybody gets the same access to those high-quality, low-cost products. So we think about this is that we've built enormous scale and efficiency into our operations, and our recent announcement's an example of how we seek to be able to share the benefits of our scale with clients and to level the playing field so they can take advantage of those costs.
But at some point, does it really matter? I mean, for a modest investment, will a 0.04% cost really make that much of a difference compared to a 0.03% cost? I also asked Jonathan for his thoughts on this. I asked him, why is it important to have the lowest cost? Aren't we kind of splitting hairs at 3 basis points versus 4 basis points?
It's an interesting question that we certainly see in the industry a lot. And I go back to what we know with certainty, and we know that cost and value really matter to investors. And even just a few basis points can make a difference in terms of a client's return and in terms of how they select the kinds of products they want to invest in. And as I mentioned, we really have, over the 25 years we've been managing index products, built enormous scale and efficiency into our operations. And that has allowed us to deliver products at extremely competitive price points. So we're really able to share the benefit of that scale with ETF investors.
But maybe things go beyond just managing the cost of the fund. After all, several companies have tried to get into this whole commission-free trading game, and we've seen that from TD Ameritrade, E-Trade, several others as well. Schwab is also in this list. They have a commission-free trading program where you can trade their ETFs for free on their markets, and I think this is probably helping to funnel investors into certain areas as well. I also asked Jonathan what is behind this success in terms of their commission-free program, and if this is playing a role in some of the success for many of Charles Schwab's funds as of late.
It's interesting. I think it definitely has helped. Without a doubt, one of the benefits that the evolution of no transaction or no commission platforms for ETFs has done is it's really allowed clients to dollar cost average more. It's allowed them to do a little bit more of that monthly investment and use ETFs as more of their savings. Whereas when they're paying trade commissions on ETFs, it can take a bite out of a deposit if you're making those on a regular basis. And so I do think the advent that Schwab started with no commission ETF platforms really has moved the needle and really made ETFs more accessible for a wider array of clients, especially those retail clients.
But how are they able to do this? I think part of it has to be the index choice and the focus of these benchmarks. If we look at most of the top 20 in terms of the cheapest funds out there, they all focus on these broad markets, be it large cap, small cap, or even total bond market. These types of products have the way to get into numerous securities, and you can spread out assets over a wide base as well. I think this really helps in terms of tradability, and when you're investing in companies like, say, ExxonMobil or Apple, it's a heck of a lot easier than buying up, let's say, companies in India or Nigeria or any other emerging market out there. So by focusing on just these most liquid securities, I think it's a huge boon to a lot of these fund providers, and it allows them to keep the costs low if they so choose. I think another area, though, is that a lot of index providers are focusing in on trying to get their name out there and trying to compete with some of the big dogs out there, such as S&P. You might find some of the more lesser-known names in the top 20 as well, and I think part of this is striking a better deal with some of the ETF providers out there, and that's also allowing them to focus in on lower costs above all else. My completely unsubstantiated theory is that Schwab can afford to do this thanks to their enormous brokerage arm. Think about it. They get people in to their system using these low-cost ETFs, and then they can sell them various other services that are probably at a much higher margin than these products, which are being sold either at cost or possibly at a loss. I think this really speaks to the long-term nature that Schwab is trying to focus on, and it could have a long-term impact on the company, and it might help them to get some of the longer investors out there as opposed to focusing in on the traders. And I think that's why you're seeing a lot of their funds focus in on these broad markets like large cap U.S. equities or small cap U.S. equities, or even the total bond market. In many ways, this is taking an Amazon approach to investing. Think about it. Amazon sucks you in via Prime at a low cost, often losing money on some services and products in order to get you in the door and keep you in the ecosystem. I think you could argue the same thing for Charles Schwab. After all, they have a bunch of low-cost products, and they're trying to get long-term investors into the door and keep them there. And if we do see interest rates rise, they're going to make even more money off the float, which is really what a lot of brokerage companies end up making most of their profits on anyway. So why not get a bunch of investors in the door now with these low-cost ETFs and focus in on the long-term investors out there? This could end up being a huge benefit to Charles Schwab relative to many of its big competitors out there, namely iShares. iShares doesn't have the same brokerage arm that Charles Schwab does, so it doesn't have the ability to spread out costs over a variety of other financial products, so it has to basically make a profit from its iShares segment. Charles Schwab is thus in a huge advantage because it can charge a much lower rate, get people in the door, and then make money on other products. Sure, you could argue that iShares is part of the much larger BlackRock company, but iShares doesn't hold the same weight in its company as the Charles Schwab ETF line does for Charles Schwab. Charles Schwab is using its ETFs as a way to get people in the door for long-term investing, and like I said, this is really more of an Amazon approach, and I think it's something that most of the other providers out there cannot match. That's why I'm looking for this fee war to continue, and why I think companies like Charles Schwab will continue to lead the charge in terms of keeping expense ratios low across the ETF industry. Companies like iShares and some of their counterparts probably won't be able to compete, and this could especially be true if interest rates rise and companies like Charles Schwab can make even more money off the uninvested float that investors keep in their portfolios while they're waiting to deploy it in ETFs and other stocks out there. So look for Charles Schwab and companies like it to continue to lead the charge here over the next couple of years as this ETF fee war continues. Okay, everyone, that's about all the time we have for today. I hope you enjoyed this edition of the Dutra Report. It was hopefully a nice change of pace from the usual interview segments that we have. But if you want more info on the Schwab lineup, you can get more at their site at schwab.com. And thanks again to Jonathan Day St. Pere, the Senior Vice President of Strategy and Product at Charles Schwab, for speaking with me about this important topic. And for my thoughts on the ETF world, make sure to go on over to zacks.com and check out the ETF Investor Service, which includes my top picks and commentary on the markets. And don't forget to find the Dutra Report on iTunes and give us a review there. And let us know if there are any topics or questions you have for us at podcast@zacks.com, my Twitter page @Eric Dutram, or leave us a comment on Facebook too. And be on the lookout for a new edition of the Dutra Report each and every Thursday. And until then, for zacks.com, I'm Eric Dutram.